Uh-oh. Hold on, guys. I think he found his way back in.
I don't know what happened, but I'm back.
All right. Good to go. All right, good. Let me start recording. All right, my amazing friends, it is another amazing Tuesday, and I want to welcome each and every one of you to the platform. I am Lorie Woodruff, your host for this evening, and tonight's topic is all about money. It's all about housing, financing, mortgage options, and I can't lead that conversation all by myself. So we got to make sure that we have the best of the best in the house to make sure that you all are getting proper information. Tonight's topic is all about the state of the current mortgage industry. And I think in light of everything that's going on right now, I think we're due to get some fair, straightforward, honest information from someone who can give us this amazing information. Now, I've been a mortgage loan officer when I first got started in the mortgage industry. So when I transitioned out of being a mortgage loan officer, it was very important for me to make sure that I am connecting my clients, my trusted clients, with someone who will be able to be honest with my clients, to be responsive to my clients, and definitely make sure that they have a great experience, if not nothing else. And I found a gentleman who does that, and I've been hanging out with him for a couple of years. So definitely anybody who, if I refer you to someone that's within my network, I've worked with this person and I trust this person. So I wanted to make sure that I introduce today Mr. Bill Saunders with Caliber Home Loans. Not just any loan officer, but he is the top branch manager in the Maryland area. So when you're looking for someone who's top ranked, noted by Washingtonian Magazine as a top mortgage professional, that's the gentleman that you're going to be talking with tonight. So I'm honored that I get to have one of my preferred mortgage lenders on the line that's going to lead us in a discussion on what's going on with the mortgage industry. So, Mr. Bill Saunders.
Lorie, listen, that's a very kind introduction. I appreciate that. And for me, it's an honor to be here with you, simply because, as you mentioned, we've been working together for quite some time. I think it's been about 7 years now that we've had the pleasure of working together. I remember when I first met Lorie, she was teaching classes for Prince George's County Pathways to Purchase. Was it around that? I don't know if it was Pathways, but it was a program that they were offering. And I signed up to go get the class, and Lorie and I met, and we hit it off right out of the gate, and just had a lot of mutual respect for each other. And the relationship has really grown since then. It started off as a, just a friendship, and then it's turned into this professional friendship where we work so well together. And I think, quite honestly, as we share that same ingredient, we both care about people, right? And I know when Lorie sends somebody to me, she's sending them to me with that confidence, knowing that I'm going to take good care of them. And I also feel a lot of pressure from that, because I know how much Lorie cares about her clients.
Yes.
That means that I have a high level of accountability to not just the client, but also to her, to make sure that the client's being treated fairly, respectfully, and appropriately throughout the transaction. And that encompasses all levels of the transaction, as far as communication is concerned, delivering and meeting expectations, and educating the consumer through the process as well.
You got it. Yes. So if you say 7, I'm just, okay, it's 7 years.
I think it's been 7. It's been about that long. I'm thinking in my head. I don't know exactly, but 7 seems about right. 5 to 7 in that window.
Good. We'll take that. So a little bit about the Washingtonian piece. Tell us about, that was a surprise for you.
Yeah, it was. It's funny, I've been in the business for over 20 years now. And, every year the Washingtonian comes out, and you got to remember, I'm kind of coming from humble beginnings. I did mortgages for about 10 years. but I didn't really elevate my production levels until the last probably 3 to 5 years. In that 3 to 5 year window, I started building a team around me. And when I say building a team, I mean like hiring some of the most incredible support people that I could find.
Yeah.
And that the implementation of those people around me has really allowed me to scale my business to levels that I never thought would be imaginable. So when the Washingtonian names somebody as a top mortgage professional in their community,
That's you.
it's based on a lot of different criteria. It's based on the same customer service, but it's also based on loan volume and how many consumers you're helping, how many people you're helping to become homeowners. And again, without my incredible staff, I wouldn't be able to help the volume that we're able to assist without them. And, I've got and Lorie, my staff really well.
You have an amazing team. And when I started out as a loan officer, it was just me and the processor. That was it. So who was on your team that makes this so huge?
So I've got 3 really incredible ladies in particular that, directly support me and our customers and our real estate partners. I've got Beth Swope, who's been with me for about 6 years now. Beth is 74 years old. She's been in the mortgage banking industry for 43 years. And she is just another arm of me. She allows us to help, make sure that we're delivering outstanding customer service to everybody. Yeah. And she works on the back end of the file in some cases. Sometimes she works the front. She's a little bit of a jack of all trades in some cases, right? Then I've got a young lady named Emily Estevez, who's been with me for 5 years now. She's 26 years old. And I always laugh because for 26 years old, for falling into this job right out of college, she was working as a barista in a coffee shop when I brought her into this industry. And she is somebody who is on the fast track to becoming a real major player in the business. She's already there. She's just doing some really incredible things right now, and she works with a lot of consumers on the front end, in particular helping with credit repair, which we're going to talk about that as we go through this conversation as well. And then I've got my processor Yvette. Yvette is just a tireless worker. Again, the key ingredient here with every member of my team is that we all care. We care about our clients. We care about our reputation. We care about our real estate partners. We care about our community. And we see the value in helping people become homeowners. That's the most important thing is we recognize what we're doing to help people. And I think that's really what allows us to operate at levels that, give us the ability to be recognized, by the Washingtonian magazine and, even the Scotsman's Guide, which is another, designation that we have. Since 2020, we've ranked in the top 1% of all mortgage loan originators in the country.
Look at you.
I'm not talking about the company. Love it. I'm not talking about our company. I'm talking about our team.
That's amazing.
Yeah, it's pretty neat. So it's a really nice thing to be able to say. And I'm proud of every opportunity and for designation and recognition that we receive. Yes. And I really do feel like it's all of us. It's not just me. I'm the front man. Mm-hmm. I'm the guy on the billboard, but at the end of the day,
ladies are helping out.
The ladies are elevating me to levels that I would never have imagined to be possible. Yeah.
Carmelita said very impressive. So definitely
thank you.
Walk into that and I celebrate you for that.
Thank you.
Typically we have a moment of celebration, but we got so much to go through. So I'll take the celebrations towards the end if you guys don't mind, because typically I like to celebrate each and every one of the people that are online, whether they did something that they think is small. It's big to us. It's big to us. So we'll save that for the end if you guys don't mind. I want to definitely make sure that we dive into tonight's topic about the mortgage industry and what's going on. So we shared a little bit about you. Tell me one fun fact about you before we start rolling.
Oh, fun fact about me. All right. Let's see. I invested in a racehorse a couple of years back.
What's the name?
And the racehorse's name was Authentic. And when I invested in the racehorse, he'd only run one professional race. So we really didn't know exactly what we had. That racehorse went on a nice little stretch where of about 11 races where he just kept winning and winning and winning and finishing in the top 2, top 3, and eventually earned himself a bid to compete in the Kentucky Derby.
Look at you. You got yourself a top horse too.
And he won.
Of course.
He won the Kentucky Derby. So I have a very small percentage stake in that horse, but I can proudly say it's a nice, I won't be able to retire from the winnings. I can promise everybody that, but
Okay.
it's a nice conversation piece, and it's something pretty neat to, talk about when the lull in conversations. It's neat to be able to share that with people. Not everyone can say they have a Kentucky Derby winning racehorse.
I'm gonna put my Derby hat on and we're gonna go out to Chipotle. How about that?
I'm in.
Okay, how about that? All right, so let's talk about the industry as a whole. We know a little bit about you. We know you're amazing at what you do, and we know the clientele and the realtors that send you business. The most of your business comes from real estate agents,
It
right?
does. Yes.
Okay. So when someone is bringing you a client, tell me what a typical day looks like for you.
Oh, it's a lot of text messages, a lot of Facebook private messages from real estate agents introducing me to potential buyers, prospective home buyers, a lot of emails, a lot of phone calls. I can honestly tell you that my day typically starts around 8 o'clock in the morning. When I say that, I'm up earlier than that, but that's when the phone starts ringing. And it typically doesn't stop until 8 p.m. at night, 8:30 at night. Again, it's a steady barrage of referrals, and I'm so blessed and fortunate to have a network of real estate agents in our community who think so highly of me that they're willing to continue to refer clients to me. So one thing I don't do, I work hard, but I don't get mad at my paycheck. You know what I mean? I understand there's opportunity here, and it's anybody can complain about how much work they have to do, but it's such a rewarding job that it really, it doesn't warrant any complaints. And to be honest with you, there's a lot of other things that could be worse. I get to work in a climate controlled environment. I've got a TV in my office if I want to have it on background. It could be a lot worse.
You got it made. You make the best of it.
Yeah, absolutely.
And
there's no weekends in real estate. There's no holidays in real estate. We feel like we're on call, 15 hours a day. And that's a real, that's a real description of what an average day of a loan officer looks like. I mean, and that's just dealing with the prospects of new buyers that are coming in. That's not even scratching the surface on the clients who we currently have under contract or trying to go under contract, or we're trying to get their loans cleared for closing. So like I said, it's not a problem by any means. And if anyone ever described it as a problem, it's a great problem to have.
A lot of work going on. I was showing one of our clients a house this weekend, the couple, the Jacksons. I was showing them a house this weekend. And, like when she asked, is he working on Saturday? I said, look, I don't know his hours, but I think you can ask. And if he responds, he responds. But I know that you are pretty faithful of even getting stuff done, even on a Sunday when I needed to get a pre-approval letter and a cost estimate, because being in our space as real estate professionals, we don't wait until Monday. We can't just wait every time, because time is of the essence for our business and our clients. Right. If something is needed, we kind of need those numbers, because it could make or break a deal. So we are at the front end, and I think you understand how severe it is. I know you've been interrupted at dinner. I know you've been interrupted in meetings, and just to get something done. So I thank you for that. Not that I bother you at dinner all the time, but
no, not at all. But
it's more than me.
It's funny you say that, because I've kind of built my career around my responsiveness. I mean, that's one of the things that makes me, I think, appealing and enduring to the real estate community, is that I am responsive. And
right, you are.
If I'm sitting on my couch, I mean, let's think about this, put it in perspective. Let's just say I am sitting at home and it's 7:30 or 8 o'clock at night, and I'm watching TV. Maybe I got a ball game on Saturday night, or Sunday I'm watching football or basketball, whatever it is. And I get an opportunity for my phone to ring, and it's a buyer that needs to get some help, or on a pre-approval, or maybe it's a real estate agent who needs some numbers for their buyer. They've got this great technology on your televisions now, and you can hit a button that says pause.
Yes,
you can do what you got to do, and then come right back up and pick up where you left off. I mean, think about it. I mean, it's really, it's not a bad problem to have when opportunity creates, is there for you to take advantage of.
So we've got different conversations. So typically, as a real estate agent, when I'm speaking first, the first step is not just let's go out and look at properties. The very first step is let's talk to a mortgage professional first, because my car does not go vroom, vroom, vroom until we get the absolute numbers and approval from you as a loan officer. So when that person first calls you, how are you walking that client down the road of getting pre-approved? Like, what does that call look like when somebody's ready to start their home search?
So that's a really interesting question, because there's an evolution in our business that's changed in the last 5 years, right? So, early in my career, it was, hi, Mr. and Mrs. Smith, I'd love to help you with your home purchase journey. I just need to collect some information from you. And you start with asking those basic questions and getting that necessary data that you need, which is name, address, phone number, email address, date of birth, social security number, where do you work, how long have you been there for, how much do you make, how do you get paid, give me the information regarding your asset accounts, checking, savings, and retirement balances, things like that. And typically with like eight to 10 key pieces of data, I could put together enough to start an application online, jump onto my laptop, put the information into the application, and then start working on pre-qualifying that buyer to purchase a home. But now, fast forward a few years, now what we typically do is we want to instruct the consumer to visit our website and complete our application, right? Now, the reason we like to do that as mortgage professionals is because it makes it a lot easier for the consumer to give us their information than us to try to figure out, did I write something down wrong? I don't want your information written on a piece of paper floating around my office all day. Your social security numbers, a lot of security involved in collection of that private information on a consumer. So we encourage people to go online and complete the online application. Now, typically once the application, but I do give every consumer the ability to ask me any questions that they have about the process during that initial consultation before they complete the application. But the reality is, a lot of the answers that they're looking for, I can't give them until they fill out the application. So once they've done that, then I'm notified pretty quickly. Either myself or Emily, who I mentioned earlier, we get notified immediately once the application is completed. We jump in the file, we review it. And what we're looking at, Lorie, is again, it's that those key critical points of data. We're looking at credit scores first. We're looking at employment and income information. We're looking at assets, and then we're looking to the credit report to identify what their actual consumer debt that is reported on the credit report is showing, and as far as balances and monthly payments, because that helps us to derive at a sales price using a formula or a calculation called a debt to income ratio. So we look to that to, kind of figure out what we can do to help that consumer. And then once I've had a chance to review that, now I've got a pretty good idea as to what type of loan program, what kind of loan product, what kind of interest rate might be applied to a consumer application. And then we schedule kind of what we're doing right now.
Yeah, I love the fact that you do those. The fact that
you sat in on those.
Included me on it as their real estate agent. I love that.
Yeah, so we get on the phone, we get on a Zoom call, or we meet in person, which doesn't happen as much as it used to, which is great because I tell everybody Zoom technology is the greatest modern day invention since air conditioning. I can meet with 5 or 6 clients a day and just stack those Zoom calls one on top of the other and go over the application process with the consumer. And here's the most important part. I said earlier that a lot of times you can't tell people what things, what interest rate or what program or what their payment's going to be until you have all that necessary data. So when we're on this Zoom call, I call this my discovery period.
That is.
It is. And it's an opportunity for me to share with the consumer what we're looking at from a mortgage banking industry and underwriting, position. But most importantly, it gives me the opportunity to interview my client and discover what their financial goals are in this mortgage transaction, in this home purchase, so that I can kind of work backwards to make sure that I'm giving them the payment goal that they desire, letting them know what that's going to equate to on a sales price, and then also go over the numbers with them as far as what their financial expectation might look like.
So let's talk dirty.
All right.
Let's talk about what people really need to know about 3 digits, 3 special digits that get people hemmed up and wondering, what does my credit score need to be to get started with you?
Yeah, so it's funny you mentioned that. When you think about credit, let's go ahead. I'm gonna jump in. I'm gonna do a quick screen share with everybody, right? Let's talk about
let's talk about credit, because that's going to be a hot topic that people got to get over that first.
Right. Yeah. So almost every consumer has, they typically will ask me, like, what's a credit score requirement for a mortgage loan? And quite honestly, it depends, right? It depends on what? It depends on what kind of loan program you're going to be utilizing. Is it a VA loan? Is it an FHA loan? Is it a USDA loan? Are we talking about conventional financing? Are we talking about any kind of programs that involve like down payment assistance, whether it's Maryland Mortgage Program, DC Open Doors, VHDA, HPAP, which is really popular right now? There's a lot of different, things that go into that. So we'll talk about that later. So when we look at credit scores, I'm going to circle back to this as well. One of the things that typically comes up, and this is a huge differentiator in my business versus I think a lot of my competition, a lot of lenders out there, they don't spend a lot of time working with people who might not be ready to purchase now, right? Maybe they have some sort of obstacle. Maybe they've got some derogatory items on their credit. Maybe they've got something that's kind of preventing their credit scores from being where they currently are to where they need to be. And unfortunately, and Lorie, I want you to really talk about this for a second. They stop there. Like if there's no instant gratification, like we live in this microwave society where everyone wants it now, right? Mm-hmm. If they can't help somebody right now, that's where the buck stops. They don't continue to work with that client. And how often do you see that as a realtor, outside of me?
That they typically won't take the time. So that's why, credit repair services are booming, because they have to take the work over. Right.
Now we offer some services to a consumer, and we do it free of charge. And we do it from a position of what the mortgage banking industry is looking at to help a consumer to be considered to be eligible for mortgage financing. And we've got these programs. We spend a lot of money on this really exclusive software that allows us to analyze a consumer credit report and then provide that consumer with some suggestions and a strategy and a game plan that's going to help them to improve their credit scores, right? So here's an example, and I've redacted all of the personal information so that this particular consumer, because this is a real live example of something that happened a few months back. As you can see on the credit report, we've got a buyer here that came to me. They had 3 FICO scores, Experian, TransUnion, and Equifax, that ranged anywhere from 532 to 572. Now, typically we need at least a 580 as a minimum, but the opportunity really increases for approvability of a loan, lower interest rates, all the things that make a loan worthwhile for a consumer once their credit score hits 640, 620 in that range, right? So if you look at this credit report on your screen right now, you'll see those 3 scores, 532, 562, 572. But underneath of that is the opportunity or the potential for score improvement. And you see I've got an 85-point opportunity for improvement, a 48-point opportunity, and a 95-point opportunity. So again, look at this credit report date, August 19th, 2022. Let's fast forward to what we fixed them after we gave them their plan and put them on that path towards improving their scores. And you'll see here, we're just a few months down the road, right? And now look at the scores, 653, 654, 623.
They're ready now.
They're ready now, right? Now they're ready. And most mortgage lenders, unfortunately, are not going to spend that time and energy and helping to provide a consumer with a plan that's going to help them to become ready, right? We've all heard people say, bad things happen to good people, right? And if you would just take a minute and review and spend some time to work with the consumer, the level of gratitude and appreciation that comes with helping somebody is just, you can't put a price tag on that.
That's major. What I know when I started, I had to identify what kind of clients I'm going to help. So back towards 2009 and 10, I started working specifically with folks that had less desirable credit.
Right.
And I can tell you, when they get their credit repaired and they do what they were supposed to do to get these kind of results or better, oh, they will love you for life.
Not only will they love you for life,
show them how to do it.
So Lorie, here's something that I've learned. Not only will they love you for life, but they become an advocate for you for life.
Yes.
They become a member of your sales team.
Right.
They're out there telling their friends, their family, their coworkers, They go high to the mountain and preach
That's
about
right.
how great of a job that you've done for them, right?
So that's for to your realtors as well, you professionals that are out there, you know, definitely the credit scores that are 680 and 700, everyone's not going to walk in your door with that. So you have to take a look and see how you can differentiate yourself as a real estate professional on what can I do? Well, start focusing on people who have the 530s, who have the 480 credit scores. Life happened, whatever it was, but if you showed them how to get connected to someone like Bill, to at least starting to get into some kind of path of remedy, you will have referrals for the rest of your career.
We never say no, we say not right now. And then we put in a plan to help people. So here's an example in the same exact scenario, right? Well, you see what magic we did with helping this client with their credit. Now, if again, you look at the bottom of the screen, it shows there's still some improvement opportunities there, right? So now while we can get their loan approved, I might be able to get them a better deal. I might be able to get them a lower interest rate with higher credit scores. Lower interest rates are going to lead to lower payments. Lower payments are going to give me some more wiggle room where debt ratios are concerned, which could increase their purchase power, right? So how do we do that? So in this scenario, we're trying to figure out how can we get this client to a 680, maybe even a 660, because that's where the sweet spots live in these 20-point increments where credit scores are concerned, where rates can be impacted positively or negatively for a borrower, right? So if I want to get them to a 660, we were able to, with only using $326 to pay down an existing debt for that consumer, we can get their score to a 660 again, $326, pay down the balance on a credit card, and there's a 97% likelihood that that buyer score will go above a 660. Now, I know for a fact from this example, he spent the $326. He asked me, what about a 680? So I said, all right, so if you want to get to a 680, it's going to cost you $2,613 to pay down the balance on that same account. And by doing that, your interest rate might get 0.25% better. Well, that client immediately said, you know what, I don't have an extra $2,600. So we're just going to ride with 660, and that 660 FICO score got him a more approvable loan, a better interest rate, and it got him into a home that he didn't think that he was going to be able to purchase otherwise, because the previous lenders that he worked with told him, well, they didn't tell him anything. They just didn't call him back. Once they saw his credit score began with the number 5, he ended up in their trash can, and they never followed up with him. And he said to me, I will never forget this, what makes you so different?
He was tired by that time.
He was done. He didn't want to talk to me.
I
had to really bring him in and encourage him to even give me the ability to have the opportunity to work with him.
Yeah, I love that. One of the questions that came up was about the accountability. So when you give them, I guess, their assignment on what has to be done, how is the accountability and follow up to make sure, you know, over those 3 months or so that they're doing what they need to do? Well,
and that's a great question. And Lorie, you mentioned earlier that when you first got in the business, it was just you, right? You didn't have the bandwidth to take on all these clients that you were working with to help elevate them to a level that they could be considered eligible, right? Same thing happened to me. It wasn't until I was able to hire people around me to operate as a team that I could kind of delegate some of those assignments to. So the young lady that I mentioned earlier in the initial call, which is Emily, that's a lot of what her, not all of, but that's a good part of her, responsibilities, is that she works with our clients and she does follow up with them. And here's a sad reality. Not everybody follows the path that we put them on, right? Sometimes they regress. We see that happen too. So I'm not saying that we're going to have 100% success rate with everybody that we pull a credit report on. We can tell people what they need to do, but sometimes it just doesn't, they have to still be a part of their own success. And
you have to want it.
Yeah. But what Emily does is she does reach out to the folks that we're working with, and she says to them, hey, just following up with you. We spoke 30 days ago. She sets a calendar reminder to follow up with them in 30 days, 60 days, 90 days. And then that way she's, reaching out to them just to make sure that they're doing what they're doing. And again, the accountability side of it really is the big component that allows us to convert some of those clients into allowing them to become homeowners.
I love it. Question came up about hard pull versus soft. Tell us about that.
It's always going to be a hard pull. From a mortgage banking side, if you're applying for a residential mortgage loan, I don't know of anybody in the industry that does a soft pull. So just kind of keep that in mind. If anyone tells you it's a soft pull, I wouldn't believe that. I think you're not being told accurately. I think maybe people aren't forthright in some cases. There's a lot of less than scrupulous people, unfortunately.
Just say they're being lied to.
Yeah, they're being lied to. It's going to be, yeah, exactly. It's going to be a hard pull.
All right.
It's going to be a tri-merge report.
You're looking at all three credit bureaus.
We look at all three credit bureaus. And the reason we do that is industry guidelines and standards require us to use the middle of the three FICO scores. And in most cases, the scores are all going to be pretty close. You may have a client with a 680, a 690, and a 700. You're going to see that. Occasionally, we will see a client with a 610, a 690, and a 750. I mean, and that's kind of weird when we see that because there are some inconsistencies there. And it typically is kind of an alarm to us that something is taking place that maybe hasn't caught up on the bureau level with all three bureaus yet. But we're typically going to be looking at a tri-merge report, and we're going to use the middle of the three FICO scores.
All right, so 580 can get me into a home, but if I need a down payment assistance, what does that score look like with your firm?
Yeah, you're looking at a 640 FICO score, depending on the program. Okay. Maryland Mortgage Program is the one that we're going to talk about today. Most of them are, whether it's Maryland Mortgage Program, DC Open Doors, or VHDA, which is the Virginia version of it, down payment assistance, they're all going to require at least a 640 FICO score in most cases. Now, there's some other criteria that has to be met. There's income limits based on where you live, where the property is. And that's based on household income. And then there's also some debt to income ratio restrictions. But as far as the actual, programs are concerned, 640 is typically what you're going to be looking at from a FICO score requirement for any sort of down payment assistance. Okay. And again, we'll help people to get their scores up so that they can be eligible to receive that.
All right, so that's that magic number. But even when I hear that, I still think, let's get you higher than that. Let's not just kind of skirt in by 641, because anything could change in the wrong time and it could take it below 640, even when you're in processing.
Yeah, we want to leave no doubt. We want the underwriter to look at the file and say, thank you.
Thank you. I like that.
Like, we don't want the underwriter to look at it and go, why are you asking me to approve this loan? We want to remove all the doubt from the equation.
So I remember prior to 2020, there was down payment assistance all out there. It wasn't a problem. Deals were probably 30 to 45 days in closing. It wasn't a big deal with our industry. During the pandemic, it was such a frenzy with so much going on with hurry up, sellers want a quick close, and some people were waiving home inspections, and they were just doing so much just to get the house. Now that we've pulled out of that, we've seen increase of house prices, increase of rates just a bit, since the pandemic started. And now we see the return of down payment assistance now back in place.
So I'm going to share
about the down payment assistance from 2020 versus 2023.
Yeah, I'm going to share something with you guys, and I'm just going to use the Maryland Mortgage Program as the example that I'm going to share with you right now. I'm seeing something that I've not seen in my entire career. And I'm talking 20 plus years of doing thousands of loans for thousands of home buyers, and I have not seen this before. So let's talk about down payment assistance. And again, I'm going to use Maryland Mortgage Program. Then I'll get to the anomaly that we're seeing right now and how it benefits a consumer in today's current market. So when you think about down payment assistance, typically the rub, the negative stereotype that comes with down payment assistance is that the interest rates are significantly higher than a traditional rate. So for example, let's just go back 4 years ago, right? And let's just say, for example, that you had a client that came in with a 640 to a 660 credit score, and they were getting an FHA mortgage, okay? So with that FHA mortgage, say the going market rate for a traditional FHA loan maybe was 6.25% then, but if they were applying any type of down payment assistance to that particular loan scenario, then the interest rate might be 3/4 to 7/8% higher than the traditional mortgage rate, correct? So here's what we're seeing right now. if a consumer wants to apply for a Maryland mortgage program down payment assistance, the government rate, the FHA rate is 7%, right? Which I know we're thinking, again, if you got really good credit and you're getting an FHA loan, I could probably get you something around, 5.75 to 6% today. But we're talking about a buyer who has a 640 to a 660 credit score, right? So the interest rate for that particular buyer, whether it's FHA, USDA, VA, if you wanted to get a 6.75% interest rate, I would have to charge that consumer 1 point to buy that rate down to give them a 6.75% rate. And that 6.75% rate would give them a payment of around, on a $400,000 loan, that would give them a principal and interest payment of around $3,063 per month, right? Now, I want to show you a side-by-side comparison. Again, this is a 645 FICO score, 640 to 660 FICO score buyer purchasing a home in today's market, utilizing FHA financing as their loan program at a $400,000 sales price. That borrower who's purchasing with a traditional FHA loan is going to get a rate somewhere around 6.75, 6.875%. They're going to have a monthly P&I, principal and interest payment, of $25.47. Their closing costs we know are going to be about 4%. You're going to subtract their earnest money deposit. And if they're lucky enough and they've got a great real estate agent like Lorie who can negotiate 3% closing help for them in today's market, then that means they might need $17,000 estimated, give or take, at settlement. That's your traditional FHA mortgage. So if you're that same buyer that I'm speaking with, I'm going to immediately take them to Maryland mortgage program. And I'm going to say, look at this. You can get a $400,000 loan, same sales price, debt ratio. I'm down payment 3.5%, 14 grand. We know that. It's compared to the traditional. It's the same. Interest rate, it's going to be about the same, give or take, which means that the principal and interest is going to be about the same. And we know the closing costs are going to be about the same, right? Here's where things get crazy. We're going to deduct that EMD and we're going to add in the same 3% seller help. And then we're going to apply that 4% grant, which is $16,000. That same buyer is going to have the exact same payment and interest rate, but the difference is going to be their funds due at closing. What do you think that buyer is going to go with? $17,000 out of pocket, or are they going to come to the table with $1,000 in the down payment assistance loan scenario that I'm showing you right now?
I'll take the Maryland mortgage for $1,000, please.
Yeah, and then you're going to save $16,000 to furnish your house, give yourself a little bit of a cushion in the event that you need it. So many things that you're going to be able to do in this scenario that you wouldn't be able to do otherwise. So again, this is if you have a buyer in that 640, 660 range. We are really highly suggesting everybody. We're really trying to educate our customers and let them know about the products that are available. And again, not every mortgage lender is the same. Not every mortgage lender has access to these type of down payment assistance programs, and therefore they sell against them because they can't offer them, but they still want the loan. So they're not really looking out for the consumer's best interest in a lot of cases.
Right.
So,
and I would say in this economy right now, cash has always been king. So even if a client said, hey, Lorie, I have $25,000. My goal is not to say, well, you don't need any other assistance. You've got it all. No,
right.
Cash is king. Your cash is king. So even as real estate professionals, I'm not looking to eat up all of that. I would definitely suggest use the state's money. Use the state's money and see if that program works for you. See if you qualify for that program. But I would definitely rely on that no matter where. They could have 30,000 in the bank. Still speak about pocketing your own money so that you can survive in this economy, period.
Yeah, absolutely.
Carmelita said, thank you for that explanation. That sounds like it was really good.
We're really spending a lot of time educating consumers right now. People, the average homeowner, the average human buys 2 or 3 homes in their lifetime. So it's not something that people just step into this with this great wealth of knowledge. They really do rely on, trusted advisors, professionals like us to be their guide. And, that's an important thing it's a heavy responsibility that we have to take on to make sure that we're treating people fairly. Now, I live and work in this community, right? I don't want to have to hide from a buyer or a customer, I should say, a client, when I'm in the grocery store and I see them. I want to be able to, hey, what's up? How you doing? Good to see you.
Exactly.
How are you enjoying your home? I
Right.
don't want to go, oh, geez, there's so-and-so. Let me go duck behind aisle 5 and get
Right.
out of the way while I'm grocery shopping.
No, we don't do business that way.
No.
So with residential, I think to park that conversation, because we can talk all day about that. Anybody looking to purchase in Maryland, DC, or Virginia, there are down payment assistance. You would just need to speak with Bill about what's going to be the right fit for you or your client.
Right.
The other thing is I have a lot of investors too. And a lot of investors like myself, I'm self-employed. So there might be times where our loans might be a little bit different. So how do you outfit someone who's an investor to get a home loan?
So that is a really unique question. I like the fact that you asked that. And one of the things that makes me unique as a lending partner is that the company that I work for, Caliber Home Loans, we are in fact what's called a servicing company, which means that we're not bundling up all of our loans and selling them on the secondary market. We're going to keep every loan for the most part that we provide. Now, the ones that are Maryland Mortgage Program or VHDA or DC Open Doors, those loans are purchased by another investor. But I'd say probably 95 to 98% of the loans we originate and close are going to be serviced by Caliber Home Loans. And that means that when you get your monthly statement, it's always going to come from us. We're not selling those loans again. So what that does is it gives us the ability to answer your question is to house what's called a portfolio product. And we have some investor loans, again, that are designed specifically for entrepreneurs. And entrepreneurs, they're not doing anything that's illegal or wrong. They're able to take advantage because they're an entrepreneur and they're exposing themselves to more risk, that they're able to take advantage of tax laws that allow them to write off a lot of their income. So the income that they actually are earning in their bank account and in their pocket may not be reflected as such on their tax returns and the traditional methods that mortgage originators use when qualifying consumers to purchase. And that's a demographic in our industry that has been severely penalized as a result. So we came up with some scenarios and some loan programs that we keep as portfolio products that appeal directly to that type of consumer, that entrepreneur. And what we offer them is a bank statement loan program. So rather than looking at their tax returns or their 1099s, we're going to go directly to their business bank accounts, and we're going to qualify them based on their gross monthly deposits. Okay, so we look at all the deposits, and then we have a formula that we use to calculate what their usable income is, and we're able to help some consumers to become homeowners as a result. Now, there is some exposed risk where those loans are concerned, so that particular loan product probably comes with a little bit higher down payment, anywhere from 10 to 15 to 20%, depending on different variables. But it certainly opens up an opportunity to help certainly an underserved demographic that maybe wants to become a homeowner, but they can't because they just don't have the tax returns to present what would traditionally be used as qualifying income.
So 10 to 20%. The kind of scores that entrepreneur would need would be at least minimum what?
We're 660.
Not too bad. So entrepreneur 660, not bad. And that rates range?
They're going to be about 1 to 1.5% higher than a traditional interest rate.
Okay, cool.
In most cases. Yeah, they do come at a higher rate. I mean, and that's just the cost of doing business in some cases. I mean, look, I had a client recently that, when he had applied for a loan with, a traditional bank or mortgage company and was told no by like 3 or 4 people. He ended up coming to me. I was able to get him pre-qualified and pre-approved for a loan. And then when we started going over the details, he said, "What's your interest rate?" And I told him. And his mindset was that the rate would be the same as everybody else's rates with a traditional loan product. And he said, "Wow," he goes, "Bill, man," he goes, I'm really glad that you're able to help me, but your rate is awful high." And I said, quite honestly, it just I don't even realize that I said it. I didn't mean it to sound disrespectful in any way, and it wasn't meant that way. But I said, "Well, how's no sound?" Because everybody else has told you no. I'm telling you yes. This is the cost.
Straight up with him.
Yeah, straight up. This is the cost to get to yes. And his response was, "Yeah, I hear you." He goes, "You're right."
Need to be spoken to a special way sometimes too.
Right.
Yeah.
So we ended up getting him a loan, and he now is a homeowner, and He's very happy with the house that he bought, and he knows that he's paying it, at a premium. But he also understands that he's able to take advantage of some of the tax loopholes that a lot of us W-2 employees don't have.
Right.
Yeah. So you can't have it both ways, right?
Yeah, it's got to be some give and take somewhere. But I think if you know that bank statement program is there, then entrepreneurs don't have to worry about, well, what do I need to do to convert? I have to get a W-2, I have to get a job for this. So at least you have that. How far do the bank statements need to go back?
Either 12 or 24 months is what we're looking at.
12 to 24 months.
12 to 24 months. Yeah, there's a lot of it depends that falls out, depending on the, the specific criteria that we're also looking at, credit scores, down payment. These things have an impact or a decision in how far we have to go back. Sometimes we only want to go back 12 months because, as we've all seen, the pandemic hurt a lot of people. So those 12-month bank statement programs can look a lot more favorable than a 24-month bank statement program because we're using an average over that period of time.
True. Are you going to be looking at like all of my debits on my bank statements?
I might, just because I'm being nosy.
Right. And then what is this secret house that you got $54.99 from, Lorie?
No,
You're going to ask me about all my purchases on my debits?
No, I'll be honest with you. I was joking when I said that. I like to work efficiently. So typically when I'm going through bank statements, I got a yellow highlighter out and I'm just going through and adding up all the deposits, because that's really all that we're focused on.
That's all you care about. All right, cool. So when investors are purchasing a home, one of the things that I don't think a lot of investors know about is if they're buying an investment property, anything up, let's say, to 4 units, that investment property has a rent schedule that's attached to that appraisal.
Correct.
So how does that help them with qualifying for an investor loan when, it's going to be an investment property? How does qualifying look for an investor?
So I'm going to share with you just a story that I found. I see it happening more and more frequently now. I think we're going through a period of what I would refer to as the accidental investor. Okay. And let me expound on that a little bit and I'll explain. You have a home buyer that purchased a house during the pandemic, right? They bought he or she bought the home. They got themselves a low rate, 2.75, maybe 3.5, somewhere in that range. And they got this incredible interest rate, and they are absolutely in love with the rate. They're in love with the payment, but maybe they're not in love with the house, right? Maybe they want a different type of home. Maybe they need a bigger home. Some life changes they're experiencing, having more kids, needing to move for whatever reason. But they got this low rate, and they know that what has been rising in the last couple of years, Lorie, what do we see? Rents, right?
Everything.
rent, inflation, everything is going up. But they've got this great rate. So while they never set out to become a real estate investor, they are becoming this accidental real estate investor because now they want to move up their level of home, but they don't want to give up their interest rate. They want to keep that rate because they know that with that rate, it comes with a low payment. And with that low payment comes opportunity for rental income. Sure. And they don't know if they can qualify because they think, because I already have a house, that means I can't take on another mortgage, because now they're going to count both mortgages against me and calculate into my debt to income ratios. So what we're able to do in scenarios like this is if we can get rent comps in a community, right? And let's just say you have a buyer with I'll just use and say they've got a $1,400 a month mortgage payment, right? But their rent comps say that they can get $2,200 a month in rental income from that. We're going to take 75% of that total rent income, and we're going to utilize that to offset the existing mortgage payment. So that allows that same buyer to be able to qualify to buy another home, buy the home that they ultimately really want, keep that property as an investment opportunity, and then have multiple homes and also have a revenue stream that's coming in that's just going to help them build more wealth throughout their life, right?
So you do have a great schedule, because I've had someone come to me and their first initial gut was, I want an investment property, where they haven't had their primary home first.
Right.
So in a case where a first-time buyer is coming to you and they're excited, they've gone to their webinars and seminars all around the county, and they're like, I want an investment property first. So what do you say to that person logically? Would that be the smart thing to do first?
I teach them about what's called it's a term we use, it's called house hacking, right? So and again, we run into these scenarios frequently. When you take out a mortgage loan, you're taking it out under the pretenses that you're going to occupy that property as your primary residence, right? That's the idea behind giving somebody a loan, because the loan terms are more favorable for a consumer who's going to live in the property and reside in that home as a primary resident, as opposed to one who's going to rent that property out. Because if you become an investor, you're running additional layers of risk. Okay. So with that risk comes greater down payment requirements. For example, 20% down in most investor opportunities, right? Higher interest rates typically are associated with investment purchases as well. But that same consumer can operate within the guidelines and the rules, and everything is legal, it's all above ground, by purchasing a home with the intent to occupy the property. And say they buy that house and they live in it for a year, 18 months, maybe 2 years, and they buy that lower end starter home to get started, right? And then after 2 years or a year and a half of living in the property, they go, you know what? Time for me to level up. I have two choices now. I can either sell the home, take the equitable gain that I have from that property, which home valuations have been skyrocketing over the last couple of years. And I fully anticipate that they're going to continue to rise based on supply and demand. But what they can do is they can sell the home, take that equitable gain, buy another home and level up, or they can participate in the house hack, which is now do the same thing that I gave the example of the accidental investor, where they can now take that property and figure out what their rental income opportunities are going to be, keep that home, and then buy a new home. And then now they've got two properties and they're well on their way to what I call mailbox money, which is at some point when they get old like me, they're going to be able to look back and just go to their mailbox every month and just get those checks, that rental income that's coming in, right?
Yeah, we like direct deposit. We're not worried about checks.
I just shows how old I
the
am.
mail system anymore.
Exactly.
So it just depends on the situation, but you have to really speak with each person to see what their goals are.
Right.
And where their money is to even determine, can I buy an investment property first? Or, if they're really limited on cash, then probably being a primary home first would be the goal to get started.
Right.
Got it.
And again, the investor loan is not as favorable for a consumer because they have to put 20% down, as opposed to putting down a smaller amount down, and also having a lower interest rate, more favorable terms, but then living in the house for a shorter period of time and then leveling up to that next one. So that's the reason why, we promote the house hack for a consumer that has long-term goals of becoming an investor by starting as becoming a primary residential homeowner and then becoming an investor through the house hack.
Move your way up. Yeah, I've got one of my
strategy.
good girlfriends is on the line. They've been doing a lot of rental property. Shakita, she's been doing not only just residential, but she's moved her way up to commercial as well. So I know she's getting some ideas. So if you guys have any questions, make sure that you are chiming in. And I want to make sure that you have your time as well if you had some specific questions that you wanted to ask Bill. But last thing I wanted to ask you about was your comparison and what your thoughts are. We've got people who are in a mindset of, I'm just going to be a forever renter because of how things are going with the mortgage industry. So what do you say to that person that is, hey, my rent went up to $2,500, but I'm still going to stay here because the mortgage industry is blah, blah, blah. What do you say to that?
Interest rates, people have kind of gotten this misconception that rates are high right now. But when you look at rates historically, they're not. We're about where we were before the pandemic. So what the problem is they've been comparing today's rates versus pre-pandemic rates. And that's creating a little bit of a, it's not reality, to be truthful with you. So when you think about interest rates, people are still thinking, well, they're so high and they're terrible. The rates are so bad. But, when I first got in the business, rates were 12%. They were as high as 17, 18% prior to that. So we've seen, rates kind of stable throughout my career, somewhere between 6.5% and 7.5%. And that's pretty normal. So we're still between 5.75% and 6.5% to 7% right now, which isn't historically, it's not bad. It's actually where the rates typically should be. Now, when I have a customer who is concerned about rates and they say, well, the rates are so high, I think I'm going to wait for them to come back down, right?
Yeah.
Several things pop into my head then. And the first red flag and trigger for me is, well, you know what's going to happen as soon as the rates come down. It's going to be like the running of the bulls in Spain. You and everybody else out there is going to be racing to buy a house. And then
will go back up.
Right. And when that happens, it's going to create bidding wars. You're going to lose opportunities where closing cost assistance is potentially being offered to you that you can get now that you might not get then. So you're kind of putting yourself in a bad spot. And then their natural, reaction to that is, well, what if I buy a house today and, at 6.5%, that still seems like such a high rate. And I'm like, well, what if you wait? And next year the rates go to 7.5 or 8.5%, right? What if? We don't know because there is no crystal ball. No. So if the rates go to 8.5%, you got a 6.5%, man, you're the smartest guy on the block. You get to brag to all your neighbors, right?
But your rent, it will keep going up every year.
Exactly. The rent's going to go up, right? But here's the best part of it. So you get a 6.5% rate and say fast forward a year from now and the rates drop to 5.5%. You get the refi, but you still bought the house. Right. And you probably bought a house at a time where you can get some seller assist as well. So now you've gotten down payment assistance, seller assist, an interest rate that you could refinance into a lower rate in payment, and you're winning the game from all angles. Every aspect of the transaction is a home run. So how do you lose there? And when people talk about interest rates, the one thing that I can tell you is history is a good predictor, right? We all know that we can look back historically and kind of see what happens. And the one thing that doesn't cheat is the Federal Reserve. We know what they're going to do. I call it the if and then, scenario. So they have what I refer to as the playbook, the Federal Reserve playbook. And we know that the buzzword in our economic industry right now has been inflation. And we know that in periods of inflation, the Federal Reserve is going to raise interest rates to fight inflation. It works as a cooler, right? It brings inflation numbers down. And we also know that, and we've seen it by the rise in interest rates. But the other thing that we know is that in periods of recession, when we're in an economic recession, and the definition of a recession is it's a period of like temporary economic decline, which trade and industry activities are reduced, and typically the GDP is going to fall for two consecutive quarters, right? Guess what? By definition, we're in a recession.
We got that covered.
Right. And again, straight from the Federal Reserve playbook, the Federal Reserve is going to lower interest rates to help in a time of recession. So we got this weird thing going on right now between inflation and a recession where it's kind of combating each other. But once inflation comes under control, we're going to see interest rates drop. So if you as a consumer are on the fence about whether or not you want to buy a house, you can wait and see what happens and continue to rent. And, depending on some other, geopolitical data and other news, the rates could go up. And if they do, you lost. Maybe you missed your opportunity. It could be over with for you at that point. Now, the other opportunity is that if you buy now, you get the benefit of buying a house now in this current market, which is you're incentivized by a lot of great things like down payment assistance programs. You're incentivized by seller concessions as far as closing costs are concerned. And we know that if the rates get better, you can refinance into a lower rate, lower payment.
Yeah, I love this environment better. 2020 and 2021, I simply hated it for my clients. I hated it for all real estate professionals. The listing agents were having a ball, but for the ones that were just like, can you please look at our offer, please? And like, there's no hope for that buyer who had everything together on paper, credit, income. They finally made it up to the bat. And they were like, you're one of 20 offers. And so I want people to also realize that when the rates were like that, it's like a huge sale. Just think about when it's Black Friday or when you've got some huge sale going on. That's what 2020 and 2021 presented itself. You had interest rates on sale. And when you've got that frenzy makes people go crazy. And they don't think logically about, well, we don't need a home inspection. We just need the damn house. Let's just waive everything so we can just hurry up and get in. And it stresses everybody out. So even though the rates were there, it just didn't make sense overall for buyers who needed closing cost assistance to get in. And Bill simply showed you a few moments ago, for that person who may be renting and may be thinking, well, it sounds cute, it sounds good and everything, but I need the money to get into a home. He showed you a comparison of how you can get not only mortgage assistance from the state of Maryland, but you can also get assistance from the transaction itself. Maybe that's our job as real estate agents, is to help you get real estate assistance by means of a seller credit to help with your closing costs. So that scenario was what, $1,000 out of pocket. So those are the type of scenarios, if you're working with a real estate agent, or if you need to work with a real estate agent, let's connect so we can get you started, because I don't want you thinking and talking to them outside who's never owned a property or who's never had any sense of economic sense at all, that's not the person you want to talk to. You always want to speak to someone who's in the business, who's doing what you're looking to get done, so that you can get a smart response, okay? Bill is always available to make sure that you've got those kind of responses. If you're a real estate agent and you haven't worked with Bill, I would say definitely make sure that you connect with him so that you can at least introduce yourself into his world to see what can be done to definitely connect further, so that you can see how he works with his clients. And you got it right there on the screen. For those that need the replay, you're going to get the replay tomorrow, definitely with all of his information. I like to screenshot that for myself, make sure I keep that. But are there any questions that you may have for Bill while you're here?
I have a question, Katina.
Hi, Katina.
Hi. I do have a loan officer and an agent, and I am happy with what they have presented to me thus far. But integrity wise, is it okay to speak to another loan officer and real estate agent, or do you stick with them? Like, how do you handle that process?
I'll let Bill talk about the loan, and I'll tell you about the real estate.
Okay.
Bill, did you drop off? Okay. Bill, are you there?
Yeah, can you hear me?
Yep, can now.
Okay, got it. Sorry, my mic must have gone out. So I'll speak to it from the lending side of it.
Yes.
You as a consumer, Katina, you should never be penalized to be a good consumer, right? So even if you're just comparing notes, right? When you find a property, talk to another loan officer, we're going to have to pull a credit. It's going to have to happen again. So that has to occur. But you as a consumer are not going to be penalized for having another loan officer look at your file. The consumer credit scoring system doesn't want to, penalize you for going out and talking to shop for the best opportunity. I mean, for the most part, interest rates are going to be close, but it's a level of customer service and education that you're going to get depending on who you're speaking to. So I would suggest, to you, or even if you were somebody who's talking to me, I willfully will tell people, hey, look, if you think you can get a better deal out there, go out and shop. The one thing that I will stand behind is you're not going to get better customer service. I really feel like that's, where we rise above. And, from a competitive position, we educate the consumer. We're walking through them. Now, our rates are going to be as good as anybody else's. The terms are going to be as great as anybody else's, but we may have some programs and products that we can apply to make the deal better for the consumer. So, Katina, to answer your question from the lending side, I don't think you're doing anything wrong to go out and look to see if there's another opportunity for you to secure, better financing terms than the ones that you're currently being, presented.
Yeah, but Katina, you're not already under contract, are you?
No, I'm not.
Oh,
I got
okay.
a pre-approval, and we've been outbid the same way you just said about the rates and everything. We've been outbid 3 times already, because
Okay.
it's been 20. We have I don't know if am I supposed to share my number? Is it okay to share with the group?
What number?
320. We got pre-approved for 325.
Oh, yeah, that's
and I
fine.
have
Okay.
my credit rate is the high is 678, and I think the low is like 630 something.
Okay.
No, actually it's not. I'm sorry, that's a lie. I'm at the limit. So my low was the 640. My high was the 678.
So, Katina,
And
let
I
me
have
ask you
room for
this.
improvement too.
Is your loan officer presenting you with other options that
The only we haven't really received his best advice was about the programming, and I wish my husband was on the call too, because he's the numbers guy. But I hear from what I hear from you guys, is the program opportunities. And I don't
Yes.
think I've heard the positive and aggressiveness of a agent telling me about the programs available.
Right.
Yes.
So on the real estate side, because I started out as a loan officer, okay? So I know the process and I understand when it comes to the time that real estate agents are taking to get you information. So when you make that commitment, I guess when that phone call goes through to me as a real estate agent, my first call with anybody is I'm educating them and listening on what's needed. And then I will suggest, here's a loan officer that may match what you're looking for. Now, that's the conversation. I always let my client know, you're the boss. You have the choice to choose whoever you want to work with, because this is a people business. You know, you don't have to choose anyone. You have to like who you're working with, because you're going to be with them all week. Now, when it comes down to the commitment with a buyer agency agreement, well, we go together at that point. Once you're signing a buyer agency agreement, that buyer agency agreement says we're exclusively working together, so that you're not working with another real estate agent. And I mean, I can still work with other clients, you know, so you're not working with any other real estate agents. There's no commitment like that with a loan officer per se, but with a real estate agent, it is, because it's a lot of time and there's no commissions that's paid out until the deal is done. So I would say for you, just to be honest and upfront, did you sign an agreement with your agent? Yes or no?
So is the agreement is once we got the pre-approval and start looking at houses? Yes.
Okay, so that's their commitment with you, and you have a time period on that.
Yes.
We're going together. And
Yes.
out of good faith, if something's not working right, or you're not liking as the client, you're not liking the way something is going, then you have all rights to say, I want to avoid this and go in another direction. But as long as it's in writing, Katina, you know, you sign on that agreement that I want to void this particular agreement, do that. There was a case where a young lady came to me and I'm asking her questions, kind of like what you're doing right now. And she's asking me specific questions about, well, do you do this? I'm like, yeah. Do you do this? And she's like, well, my agent doesn't do that. And so in that case, I'm like, look, I can't tell you what to do. And I respect real estate agents in my community highly. So please make sure that you're giving them the benefit of the doubt. Try what we talked about and then see if it works. And she went away and she never came back. So maybe that, but I work a lot with agents and I would never want to overstep my relationships with realtors that I have in the community by taking you just because, you know, that's not the way it works. But I've also got clients that are like, I can't stand my agent and I just got to go. And, you know, and
so I don't have any problems thus far with our experience with them, but just being on this informational call, I don't feel like I got the same programs thrown at me.
Then just ask your loan officer if do they have these particular programs available in the state? Are you looking at Maryland, Katina?
Yeah, Maryland, yes.
Okay, well, ask them, are there any down payment assistance available for our case?
Okay, but I pretty much match the ones that you guys use as examples. Mine is like level on with that. Yeah,
just ask and they can, you know, if they say no, then that's another decision that you have to make. If you could save thousands of dollars by transitioning to another loan officer, then you have to do that as a business. That's a personal decision for you and your husband to do that, because that's a lot of money, because just because one company doesn't, one other one will.
Right. And if they try to sell you against a program like that, that's when you might want to be a little suspicious as to whether or not they even offer it. So
red flags.
Okay. Red flags.
Big time. Yeah. So just ask, you know, make sure that they're educating you, getting you, and you don't know what you don't know. So you don't know what to look for. Many times until you start getting outbid, maybe it's not the agent. Maybe just the economy that we're in is that some other clients are just bidding up and they got it, you know, so.
And one more question. I don't want to hold you guys.
No, this is a good question.
The other question is, this is my first process, but I have a lot of intuition. So we were first starting to look at homes at the highest level of the rate we got, but that's how we got outbidded. So now I'm looking at ones at least $20,000 or less so that I can offer something and they can offer me something. Because I feel like that's why we were being outbidded. But the market is right where we are.
It's a process. Yes, you got to figure out what works, because you got to get in there like, okay, that didn't work. Maybe I have to look at homes that need a 203K loan. Maybe I need a rate loan. I can look at the houses that don't smell that great, but I can put my own personal touches to make it mine, because those houses that look and sit for over 30 days, everybody's overlooking that because it doesn't smell good, or it's not the home that I can move right into.
It's not turnkey.
It's not turnkey, but you know, I've got investors like Shakita and Alicia on the line. They're like, I'd rather take that house and be able to put in a few $1,000s of my own personal touches. And yeah, you could get closing help, and you can probably get into that house quicker than the house that has 20 other offers on it.
Yes. Okay. Thank you.
Got it, babe. But we'll give you the contact information. So if you do need a reference, let me at least make sure that whatever you're doing, you've got the questions to ask your person, okay?
Correct.
I would appreciate that. Thank you.
Absolutely.
Good. Anyone else have any questions before we sign out? Alicia, how's everything going in your world with real estate? Anything you wanted to share? Who else is in my real estate world over here?
Hey Lorie, it's Shakita. Can I say I'm so glad that I got on this call, because I was about to string my hand around a couple lenders or necks, because it's like they don't want to work with entrepreneurs. They want to work with W-2 employees because they're easy. And I get it. It's a lot of paperwork when it comes to us. And I'm like, look, this is just, yeah, it's a lot of
entrepreneur too. And they did well with that process.
It's a lot of paperwork because we have multiple properties, and I know it could be a headache, but I mean, I just feel comfortable with Mr. Saunders. I haven't even met him or spoke with him, for somebody that can vouch for us. And it's a program that for us, the taxes are fine, but the bank statements are fine and dandy as well, because other loan officers, they're like, oh, well, you need to do this and do this. I'm like, okay, well, I don't know all the answers. The paper is in the paperwork, but I can give you the number to the CPA. They don't even want to do that. I'm just like, okay, so you're just like the other one. So click, or I'm not calling you back. And like, people shouldn't be in this space if you just want the easy way out. Same things with agents. Like, you should be able to work with people that have credit problems, because they're going to be your longest customer in the long way, because this is not going to be the last house that they're going to buy with you.
You're 100% correct.
And I think you just have to ask, and especially because you're in the real estate industry anyway, you've got to be able to have those relationships up front when you don't have a property, and just find out how they work, how they talk, and how you vibe with them. Because there are some people I've cut off of my preferred list because they got a little bit beside themselves as far as they feel that they were owed everything. I was like, you've got to earn this business. And if they're not speaking the language that you like, Shakita, then you have to interview them and just say, thank you. It was nice knowing you, or, hey, I'd love to do business with you. You'll know when you speak on the phone with them, but speak with them on the phone when you don't need them. Okay? Because that way, at least you can start asking more questions without being under a stressful type situation. At least you can understand who they are and how they work. Tell me about your team. How do you work? You know, how do you follow back? Do you typically call back, email? Like, how do you respond back to me? When, you know, all those kind of questions that you as a consumer need, ask them up front.
Right. And then they started, it was a red flag, was speaking to you all tonight, because all of them said soft pull. That's why I asked that specific question. Is it a soft pull or a hard pull? And usually I'm thinking with a loan officer, they want to see your credit report in detail. A soft pull doesn't really give you all of the information that you may need.
I didn't even know that. I didn't even know that. That's a lie.
Yeah, soft pull is not going to give them what they need for a mortgage, not for a mortgage report.
Right. Cool. Love it, love it, love it. Alicia, did you want to share something about what's going on in your real estate space?
I think she's here, but not here. I think she's can't hear us. I'm not sure what's going on.
I understand.
I'm here.
Hi, Alicia.
She's
Hi,
here.
how are you?
Doing great.
Good. What was your question, Lorie?
Superstar Keller Williams. She is in the top 10 of her agency with Keller Williams. Do you have any opinions about anything that we've been talking about today, or anything about the economy, or what you've been seeing with your clients over the last year?
No, I like the fact that, again, Billy takes the time to have that Zoom conversation with them, because that's important, because again, a lot of, well, I won't say that, but you know, most people, they take the application and then they're going really, really fast and like, here you go.
Yes.
And then that's it. And the client is like, but I don't even know. Like, they don't know anything. They just have a pre-approval letter.
And Lorie will tell you, I invite the realtor to be part of that. I have to get the permission of the consumer to sit in on that, because we are talking about, privacy, rules and things like that. But I think it certainly does eliminate a lot of confusion that can be, things can be lost in translation between the buyer conversation with the lender, and then they go back and talk to their realtor and they say, my lender said this. And things get kind of mixed up there a little bit. So if we're all on that call together, what it does is it allows us to kind of work, together as a team. It really does. It kind of solidifies that relationship for everybody.
Right.
One more thing. Yeah, I agree, because I've had that experience where, again, the client comes back and I'm asking them, okay, so, are you qualified for a first-time homebuyer program? Your credit score, is it good? And I'm asking them all these questions. What do you qualify for? And they
don't know.
They're like, I don't know. And I'm like, okay.
Like,
Did you
let
have
me
a
call Billy. Let me call Billy to get all the skinny on it. So it's good because Billy is on the phone to help digest some of those big words that the customer is like, what?
Yeah.
So yeah, you keep that up. And one other thing I stole from you, Billy, Ari, I'm coming right to you next. One thing I stole from you, which was good with accountability, is that follow-up. You use Google Calendar to make your next follow-up appointment. So I use that now. So when I have to do a 30-day follow-up, I now go into Google Calendar and set the appointment like today. So it's already on the Google Calendar.
Yeah. I wake up every day and I've got appointments that are set in my calendar that were made 6 months ago in some cases. Where I opened up the appointment, I go, I don't recognize the name all the time. I'm gonna be honest with everybody, but I look at the notes that I have from when I set the appointment for myself 6 months earlier. And then I'm able to go pull the file, look at it, look at where they were at the time that we last spoke, look at the notes, which were typically the instructions on what we're advising the consumer to do. And then when I get on the phone and I talk to them, right there, we're picking up right where we left off.
It's good. I like that. So I stole that from you. Ari, you had a question.
Yes, I do. So for Mr. Bill.
Yes.
Okay, so Lorie knows that I'm going to be selling my house soon. I've been her baby for the longest time. But anyway,
yes.
And then hopefully within the next, I would say 6 months to 12 months, I'll be purchasing again through her soon. So any advice for the both of us or for me, and will I qualify for any programs again? Because it's been over 7 years since I purchased from my initial first time.
Okay. So to answer that question, quite honestly, is it depends. I really need to have that initial conversation with you, direct you to my website, and I would advise that you do not complete the application and allow us to pull credit until you're within, a 6-month window before you're ready to buy. And now our credit reports are typically good for 120 days. So you might ask me, why would I pull my credit 6 months ahead of time? Because if there is anything that's on your credit report that needs to be addressed, you want to give yourself a little bit of time to do that in the event that your window is to purchase within 6 months. Okay. So when you're ready, when you're about 6 months away from initiating the process of knowing, hey, this is when I want to get the keys to my new house, let me take a look at the credit report. Allow us to follow up with you, do the Zoom call. If you're ready now, then we're going to direct you down that path towards moving towards the pre-approval by collecting the documents that we need to substantiate the pre-approval, bank statements, pay stubs, W-2s, tax returns, driver's license, things like that. And if there is anything that needs to be addressed prior to issuing the pre-approval, we now have given ourselves adequate time to touch on those items that might need some extra attention. And that's where you'll see really where the magic happens, where we're concerned. You'll get to work with Emily and myself to help get you in position to be considered eligible, but not just eligible, but also eligible for the best rate terms and programs and products that might be available to you.
Okay, thank you.
You're very welcome.
So she's selling a home in Maryland, and from that, you'll take the proceeds from there to use as a down payment on the next house. So I guess the question that I want to know also is, do you see people who just sold a property getting down payment assistance through the state?
You know, you don't have to be a first-time home buyer to get down payment assistance. There are two different buckets in which the home buying consumer can fit into. One is specifically designed for a first-time home buyer, and one's for potentially a move-up buyer. Now, there are typically some rules about you can't get down payment assistance if you own another property. That might be a deterrent or an obstacle, but yeah, it doesn't matter whether you're a first-time home buyer or not. There still are programs that you might be eligible for, depending on, you know, the criteria in which the program has to meet the guidelines.
Good. So it wasn't just a one-time deal area that you just lose it because you already purchased your home years ago.
Right.
So that's good. So yeah, we'll talk about that when you are ready. So I wanted to wrap things up as we are at that point. So I wanted to make sure if you, Bill, wanted to speak to you, if you could think about the next 5 years, what would you be doing?
What am I going to be doing in 5
What are you
years?
going to be doing in 5 years?
Hopefully I'm helping more people than I'm helping today. That's my goal. I mean, like I said, I like my job. I really do. I mean, it's 8:30 at night. I'm still sitting in my office right now because I like my job. I like people. I'm a people person. I like the reward that I get, the sense of reward from helping people to become homeowners. And I don't feel like my job is a job. I don't look at it and classify it as work. I really don't. I mean, I feel terribly, just extremely blessed and fortunate to be able to do this. And it's ironic because I accidentally stumbled into this business. You know, when I was a young man, I set out, I was going to be a union iron worker. Like, talk about a 180, right? I did a complete 180. I got in a car accident. I broke my neck. I broke my back. My doctor said, you know, I had a long recovery period. My doctor said, you need to get out of that profession, son. He says, you're young and healthy now as a 20-year-old, but you know, when you get a little older, you're going to regret having spent a lifetime of swinging a hammer and climbing around on steel and, you know, and just kind of working in that abusive, you know, environment, cold weather, hot, heat. So, I mean, again, I get to come to a job where I get to sit at a desk. I get to talk to people, which is something that I love doing. Right. So, I mean, it's 5 years from now.
5 years. Well, you're
5 years from now, I'm still going to be here doing very much the same thing, helping people buy houses. I mean, it's funny you asked that. I don't see myself doing anything different.
I like to ask questions that make you think. That's all.
Yeah.
And I think for a lot of us that are on the line right now, just understand a lot of us are problem solvers. So we love what we do. We stay with what we do, and that's why we keep doing it.
Yeah.
So we're problem solver, no matter how it's fit. You know, we just get up and every day is different. And I think that's the best thing of what keeps you going, because every day is different. So it keeps our ADD kind of in line so we can just keep doing different stuff.
Yeah, absolutely.
Well, I want to thank everybody that joined in. It's always a pleasure bringing you topics. Remember that every single week, these topics are for you, whether they're topics about real estate, business, credit, social media, or definitely anything about starting or marketing your own business. These are for you. So if there's anything I can do to help with your business or real estate questions, please make sure that we are connecting. I'm on all social media platforms. You can find me on Lorie Woodruff. And definitely this replay will be out tomorrow so that you can enjoy more of this. So I want to thank Bill. Thank you for sharing all of your knowledge. I know that people will definitely want to get in touch with you this week and definitely put you on their preferred list, just like you're on my preferred list. So thank you very much for everybody that took the time to join in, and I'll see you next week.
Thank you, Lorie. Thank you, everyone.